you just have unfair advantages over the public market. But the reality is, when I joined SCS, we had $7 billion under management. I was investing maybe $250 million a year. Now it's like about $1.5 billion. It's amazing to me that the wealth management industry, it continues to be so fragmented, so underserved. If I do 10 funds, what I've found is 3 to 5 exceed expectations, 3 to 5 meet expectations, 1 to 3 underperform.
How quickly do you think you know the outperformers and the underperformers?
Like,
Peter, I am so excited for this. We've been friends for a while. You've been an amazing partner to me. So thank you so much for joining me today.
Harry, it's an honor. I'm a big listener and great friendship, and thank you for having me.
Not at all, but you said to me before that you entered the world of LP and venture when you didn't really know what a multifamily office was. And so take me to your entry to SCS and how that came to be first.
Yeah, I mean, I'll back up for a second. So when I was at Georgetown, I wanted to be in the investing side. I thought I could go right to the buy side. And then I found out, you need to do investment banking. And I worked at a scrappy, really kind of, second, third tier investment bank. But it was during 04 to 06, there were a lot of deals getting done. And so at a very young age, I was running around Santo Road doing financings with CEOs. I was doing IPO, being at the printer, like leading like a team of accountants and lawyers and the guy from Deutsche Bank. And so it was a very scrappy, I didn't maybe get the best training in some ways, but formal training, but like go out there and do stuff was incredible. And my boss, Jeff Barlow, who's actually currently the head of banking, CEO of Canaccord, was a great mentor to me there. But I wanted to complement that with a private equity firm, and I ended up at HarbourVest, which was kind of the opposite. We're great process, great people, and I saw the entire private equity world. And it really was a great insight into the different pockets. When I went to business school, I thought I would go into either lower middle market investing, either kind of on a controlled buyout or growth equity side. And I was interviewing and calling a bunch of Tuck alumni GPs trying to get a job. And one of the guys I called was like, well, I don't have a job for you, but the guys who manage my money are looking for a private equity person. Given your background at HarbourVest, you could be a good fit. So I was interviewing with like 4 or 5 direct shops and then this random thing. But then when I looked at it, I said, wow, this is an opportunity. They had $7 billion under management at the time, 0 private equity. And there was one client that was investing $250 million a year in the space. The comp was like the same. Like I had a vice president job at one private equity firm where I'd be the 8th person on a 14-person team, or build this out from scratch. And I took that, and it's been amazing. I mean, it's really surpassed all expectations.
And this was 2011, correct?
Yeah.
Okay, so you said before in terms of timing that 2011 was quite a fortunate time to be kind of coming in.
Totally.
Can you talk to me about the impact of market timing in that respect, and then how that timing compares to today?
In 2011, people were still reeling from the global financial crisis, right? I had river guides, so to speak, but I would just reach out cold to many GPs, and they would take my call. They would want to meet. And that changed. I mean, I think probably in 2016, 17, like a lot of funds were really oversubscribed quickly. But being in that moment where the power shifts, where there's a dearth of capital on the LP side, and there's that is a ideal time to scale a program, to build a program, and that's I was fortunate to be.
Can I just push back on you there? I'm just interested. Yes, but you also backed the first funds of Thrive, of Andreessen, of Founders Fund, from what I know, and so actually they weren't obvious bets then.
Yeah,
so
totally.
You saw ahead of time. So actually, is it not the same as today? You just see ahead of time.
Thank you. Yeah, no, you're totally right. So I had a choice to make. I could have invested in, the B plus A minus funds that were, been around for 20 years on Sand Hill Road, because I couldn't get into Sequoia, Excel, Greylock, and Benchmark.
Yeah.
But I could probably get into pretty much everyone else.
Yeah.
And we managed money for the founding partner of Excel and Greylock. So I knew that it was tough to get into those funds because I had it in, and it still wasn't like. And so we had a choice to make. Do we want to go into, and I don't want to pick on firm names, but someone that's is very good but not quite in that top tier, or pick the next gen emerging winners, right? And we opted to do the latter. I mean, Andreessen, I would say, was fairly obvious that was interesting when we backed them in Fund 3. Founders Fund, Peter Thiel, there's just a lot of controversy. And I know the Social Network movie inspired you a little bit, but that was around the same time. But I'll tell you, like Steve Ersaglio, who is our president and CIO, who you know well, he was extremely supportive of Founders Fund. Like that was one of my first meetings, was in meeting with Peter and, doing that. And that's worked out incredibly well. And we were one of the only institutions in it. I mean, there were not that many institutions. Now everyone wants to get into it. And also, like, Josh Kushner was 27 years old, but we thought New York was interesting as a venture market. We thought Josh was incredibly impressive. Mm-hmm. It's funny. We weren't worried about it. We were high conviction on both those things. And credit to Steve, but also my CEO, Pete Mattoon, partners like Tony Abbiati, like they really supported me from the get-go to do things on the fringe. And I would say, and not to ramble, but on the buyout side, there's a group called Shore Capital, which Justin Ishbia at the time was 32 years old, and he had 3 partners that were 27, 28. And we were the first check there. And I like to say that I got as much or more pushback from the get-go doing Bain Capital as I did doing Shore Capital. And there was an appetite for risk and an understanding of the attractiveness of the lower middle market from the get-go, and a really supportive culture. So it was really, I think, it was my mindset, but also being in the right place.
Listen, we said that we were going to have a very natural conversation, and so I just want to go with that, which is, bluntly, when you say about risk appetite, I think one of the broken elements of LP world is that there's no incentive for you to take a risk if you're in a large pension fund or if you're in a large... Why would you bet on a 27-year-old Kushner when you could just do a tier 2, tier 3, you're never going to get fired for doing X brand name? Do you agree with me? And do you think that's still exists today?
I think that when we can walk through the whole LP landscape, but I am incentivized around performance fees and around. I'm in a financial organization. We're a multifamily office. We manage $30 billion from 200 families, and I'm the equity as well as the carry that I generate. I'm trying to, and I put a lot of my own personal capital in it. So I'm trying to get the best performance and the best risk-adjusted performance possible. And I think that a lot of like state pension plans or larger sovereign wealth, I mean, they structurally have major issues. If you think of like some of the big states, right? They can only they have a rule in their charter that they can't be more than 10% of a fund, and they can't write less than $100 million check. Therefore, they can't invest in funds that are smaller than $1 billion. Like that is a structural like impediment to what they do. You layer in the fact that there's political considerations and the fact that the people get paid not that well. You're going to have a lot of turnover. Yeah, I mean, that is the issue with a lot of, the big pools of capital in the private equity world. If you think of the endowments, I think
so let's just dig in. I'm just fascinated. So what would you do if you're them?
I would partner with SCS.
You would?
Or, a niche fund. I would carve out a mandate or do it in, state of Wisconsin with Brian Nobis, who I love. And now he's back at Liberty Mutual. Brian was doing like very edgy stuff. So there is like in the lower middle market land, and he's a great talent. And so there is precedent for certain like big institutional pensions to do stuff, but I can't think of a second example.
I got you. And so if we just go through...
Typically, but you partner with like HarbourVest or, whoever, like pick your niche fund of funds, carves out an SMA to do it. And I think they should probably do more of that.
Do you not lose your abilities to do directs then? You hand over that relationship, you hand over that mandate, and with that, you're not going to get the relationships and the touch point to give you access to do the directs.
Well, most of these bigger pools of capital don't do a lot of direct investing anyway. I mean,
do you think they should?
I mean, I think direct co-investments are a really important part of a portfolio, right? And so, I think it's difficult if you're meeting quarterly for an investment meeting. You can't do a lot of direct stuff, right? I mean, I'll give you an example, and we kind of in the prep for this, mentioned a situation with a London manager, Tenzing, where there was a co-investment. I was on the LPAC and basically very attractive. It's going to work out. It's going to be like a 4X plus deal. But one of the LPs, so Tenzing reaches out. It's like late July, early August. Short time fuse on the thing. And they're charging carry. They're charging 10% carry on the deal. I respond. A single family office here in London, one of my favorites, Burgal, responds. We do the deal. And one of this, it's actually kind of a fund of fund. It's like a fund of fund / like consultant allocator, takes like 4 weeks to get back. And then in the LPAC, like 6 months later, the GP got chewed out for, not giving them 4 weeks to do their due diligence and for charging carry. And they kind of neglected, they didn't mention the fact that like they didn't respond for 2 weeks because they were probably on holiday. But I like absorbed it. I was listening to this allocator just like ream out the general partner, and my blood pressure was like rising and rising. And then when we finished, I was like, that's on you. You didn't respond to this. And the fact, what we want for our managers is for them to stay disciplined on fund size and generate the best returns. And so by saying you can never charge carry on a co-investment means that they're just going to solve for a bigger fund and become asset managers and not deliver the alpha that we all want as investors. And so, and the GP afterwards, I could go on, but like it was pretty heated. I've only had, that's a one of one. But the GP was very appreciative, and I think in general, what I want to do, what makes me, I think, a really good LP, right, is you want to be like responsive, like when they need you, you respond quickly, and you want to move quickly. You want to think creatively, like you don't put things in a box, right? You think, how can we both win together? Because I think that's definitely, if you're too box checking, and you see that a lot in the institutional LP world, where they just go through and they have like their checklist of things. And the reality is that is not what's most important. People give you a reference list. I just assume now every reference is good on that list. I want to find who's not doing the fund, who has connectivity to that person that's off list, because that's where you actually are going to get real insight. But I think 95% of my peers just like do the reference list.
For sure, or not actually. I think they do that, but they also go like, oh, I want to see the track record and I want to see last fund. How much of an emphasis do you place on track record? Because I think for a lot of LPs, it's quite a crutch.
Yeah, I mean, I think track record is important. Like it tells you, do these people know how to invest? Like, are they smart? But for me, and I say this often, it's like, maybe it's number 4 or 5 on my list of things that are important, like the quality of the team, and we can get into what that means. But like having it be an attractive opportunity, having the team have competitive advantage to persecute that, having the fund be right-sized for that opportunity. Those are like, and good alignment with that team. Like those are the key things. And the tracker is like, okay, yeah, they know how to invest, because we're not investing in the last fund, we're investing in the current fund.
I'm so pleased that you said that, because I spoke to so many of your managers. I spoke to Neil Mater, I spoke to Jack Allman, I spoke to Kevin at Heritage. And I mean, the unifying theme with you was this unwavering ability to tell manager quality quicker than anyone else. It's like gut intuition. Where do you think that comes from, and what signals give you such confidence so quickly?
I was thinking about this, and
because you do. I know
you kind of know it. It's
do.
Hard to articulate, but I think if I had to say, it's like, who's a force of nature, who's gonna like, and you're one of those people, right? Who's gonna like run?
My mother says the same.
Who's gonna run through walls? You combine like ambition, work ethic, passion for what they do in an attractive space. It's powerful, and I think it's so. Justin Ishbia is one of my absolute favorite human beings. He, by the way, his brother built a huge mortgage business. Like he's worth like $5 billion. Like it's crazy. But he works like he's an animal. Like I talk to him often at, it's like before 7 a.m. East Coast, he's in Chicago. So it's like at like 5:30 or 6 when he's on the elliptical, or after his dinner. And it's not about it's not about the money. It's about the passion of building, in the case of Shore, the greatest lower middle market fund possible. But, across my set of relationships, there's, and you would be that type of person too. I mean, we're often on WhatsApp.
Yeah.
It's like 9 or 10 my time. And I'm like, Harry,
go to bed.
It's like 3 a.m. Okay. Like you should, but I think that's also what makes me a good LP is that I'm kind of wired that way too, which is like, I love my job. Like I get to partner with the smartest people in the world and give them money, and I'm, don't bother them when I don't need to, but like kind of sit at that 10,000 feet, 30,000 feet. I get so much positive energy from that.
Have you always approached it with that lens, or has it been an approach that you've learned over time? Because it's more common that you'll come in with a more studious, analytical approach and you build the intuition. Or did you always have the intuition?
I think I always had I mean, by the way, first of all, I didn't know, and I could have been like a good GP, I think. Like
I agree.
I would have been like maybe very good, but I wouldn't have been great. I think I'm a great LP, right? And I didn't know, like I said, it was luck. I stumbled into this, right? But from the get-go, I think I had an intuition on like, great GPs. But I have learned and I've gotten more confidence in my ability, because when you see 2,000 funds, now I know what great is. So when I see great, it's like, okay, it's not when I'd seen 50 funds and like thinking that they were great. And, I have evolved a little bit so talking about the force of nature, like I've always kind of been attracted to the force of nature people. If I look back at mistakes, I think, probably the number one thing is doing off-list references. Like don't get in the echo chamber of talking to like the 5 people that are backing the fund and like, they all love it. Like, yeah, obviously, right? Like you talk to their, their founder, their brother, like, yeah, they love them. Like try to find the contrary view. But then the other one was I backed a lot of.
What do you ask them when you're trying to find that contrary view? Because you're trying to extract knowledge that is tougher for people to share. It's kind of a negative.
Well, you have to have a trusted relationship on the other side of the phone, and usually it's just me. I don't have like my team on that call, and you just kind of ask. I know you love them. They're great. But like, what are some issues? Like what, like you kind of tease out like the negatives.
I always
in
ask,
a soft way. Yeah.
I always ask that, if we were hiring someone underneath Peter to support him, what skills would they have? Yeah. And they go, oh, well, they'd be super organized. They'd be very rigorous and analytical.
That's right.
And you're like, okay, you just told me what we need.
Exactly. And
I love that one.
It's
this evil feeling of like you've just won.
Yeah, no, totally. And
dude, has your intuition ever been wrong on a person in terms of a manager that you've backed? And if so, what did that teach you?
I don't think I mean, it's a boring answer, but I don't think I've had bad intuition. There was a situation where and this turns into a positive, but my colleagues knew a person going back like 10 years, when they were based in Boston. Then they moved to Silicon Valley. And this is the same example. I'm not going to name names, but my senior colleagues knew this person really well when he was like 24, 25. Then now he's like 35, 36, right? Not the same person that he was. But I had that firsthand from my colleagues, like, yeah, like we know this. And then I did a bunch of referencing. I had out of the blue, some of the biggest companies in the world, founders proactively calling me on references because they told me, and I'm like, wow, oh my God, like this person wants to talk to me. Jeez, that's really cool. And then I talked to some of the LPs that were backing them, and they're all like, yeah, this is great. And then when Fund 2 came around, I was like, looked at the portfolios, kind of wondering, and we were out in San Francisco with them, and I was like, this behavior is just like off, the way they were acting. And we were one of the only LPs that passed on that fund. And there was a few really prominent new LPs that came into Fund 2. And they were like pretty kind of unprofessional about our pass and arrogant and whatnot. And then, believe it or not, like there was some major issues with that firm. And so I think that was a really kind of like a big learning for me.
Do you worry about the off-list reference? And what I mean by that is there are many great managers that bluntly will have very negative things said about them for many reasons.
No, take it with a grain of salt. Take everything with a grain of salt.
That's it. Do you know what I mean?
Yeah, just understand, like, haters gonna hate, totally agree.
In terms of the managers that we back, I'm fascinated on the fund side. How do you think about the right level of diversification? Because you see a lot with very large portfolios, 30, 40 funds. And then you see some who take the completely alternative approach and are very concentrated. How do you think about the right level of diversification on the fund basis?
Totally. This is one of my favorite topics.
Mine too, which is why we get on so well.
Yeah. What I do well, and it's a barbell approach, and I have some big groups, but the vast majority are very niche targeted focus funds, right? Say a buyout vintage. I might invest in 10 funds, right? 10 or 15 funds. You could also invest in, 3 or 4 funds. But those underlying funds are diversified across different industries, sectors, so they might have a company count of 50 or 60, whereas I'm investing in, 3x the number of funds, but the funds have 6 to 8 companies in there. Mm-hmm. So it's not like you're taking that much more portfolio company diversification, but I think it's really important to have the manager count if you're going to do things super targeted. And the other thing I would say in this, if I do 10 funds, I'm really excited every single one, because by the way, I looked at 2,000 to choose my 10. So it's the acceptance rate is very low, right? And I'm super excited about all 10. But what I've found is 3 to 5 exceed expectations, 3 to 5 meet expectations, 1 to 3 underperform. And you still make money. It's really hard to lose money in private equity in a fund. If, let's say, a typical large buyout's going to do 2x, that basket will do 2.5 to 3x. And those outperformers might do 4x, right? And the underperformers do 1.5. But I don't know.
How quickly do you think you know the outperformers and the underperformers?
It's 4 years. It takes a while. Yeah. And that's the tricky thing with the velocity in venture, for example, because you have no idea, right?
Well, how do you feel about the compression in deployment timelines? We saw people move from 3 years to 12.
It's so obvious in retrospect, right? I mean, but I just want to know.
What does that mean?
Warren Zev, for example, we both know and love. He's just very transparent about what he's going to do. So I would size my commitments accordingly. So it's like, if you tell me you're going to put out your fund in 6 to 12 months, I'm just going to size you at a half bite. Understand expectations and what you're doing. But the vast majority of my managers basically were put out their funds in 2020, 21 in a year. We now look back on that and it's obvious. At the time, I said SPACs were I made the comment, I was 85, 90% of these SPACs are going to be a disaster. And it turns out I was wrong. I was too generous. So I'm not, but on the fund size, on the deployment piece, I think I was less perceptive of, you kind of realize wow, this is crazy. It's not going to go on forever, but
Do you think we just have a shitty vintage on performance then when we look back at 2020, 2021, given high entry prices, given compression of deployment timelines?
Yeah, I think it's not going to be the best vintage, but that's why it's really important to partner with the best people. So if I look back and I did a bunch of co-investments, in what I believe to be great, in some cases, great companies, right? But they're going to have to grow into their multiples. So rather than making 4 to 6x, we'll make 2 or 3x.
Are you seeing managers remark their books? You mentioned there about
totally. In my core relationships, Founders Fund's the most extreme because Peter Thiel's very contrarian, and he wants to reset the mindset of his team, which I think is great. But Andreessen Horowitz, Greenoaks, Thrive, they've all proactively marked down their companies. But there's a huge dispersion between where things are marked, right? Accountants will sign off on pretty much what the GP tells them to do. And so a lot of people hold things at last round, which is ridiculous.
My question to you is that I get you. The challenge is you have fund of funds who say, no, Peter, keep it high because we need to go out and raise in Q1. And so just keep it high, Peter, for us. You have others that say, hey, we're paid on TVPI. Well, they probably don't tell you that, but they are paid on TVPI. And they don't want you to mark down your books either.
I know.
And I almost feel for the GP in a way because they have all of these competing...
By the way, there's not a right answer. What matters is DPI at the end of the day. But we're all judged on interim performance. If fund of funds are doing that, that's like perverse and, whatever. But I mean, there are endowments that pay their staff on marks, right? It's weird.
Sure. Many.
For example, for me, I'm incentivized by like European, like long dated carry. That's, you have to have the distributions to get that, right? So I think the incentives are correct there. I mean, I don't want to look at a mirage. But I also don't want people to be like too crazy. Like, there's a middle ground. But yeah, I think there's definitely incentives like that, what you're talking about with fund of funds, or you think of the way some of the endowments are compensated. I mean, endowments also, there's some that are great, but I find in general, there's a lot of groupthink in that world.
It's very unfair of you, Peter. How could you?
Yeah, but
it's like, Yale are doing it. Oh, we'll do it.
I do think fund of funds get painted with a bad brush, but I think people do really good work.
Oh, do you not think, though, that actually, just to be fair on endowments, they're just under-resourced? They're under-resourced in terms of, bluntly, they have shit comp. They're, bluntly, incentives on upside are not really there. And they're under-resourced in terms of team for the segments that they need to cover. And so they're kind of left going, we can't know the early-stage venture market in the US as well as we'd like. Sod it. SCS and Peter are fantastic players. Let's just follow them.
Yeah, I think that's right. I mean, I also think there's often a generalist model in the endowment world. I mean, I sit on our investment committee and I look at what the public team does, but like it is beyond a full-time job trying to cover private equity. Like, yeah, some do it better than others. I mean, a lot of the endowments, by the way, are also just like with a denominator, Sequoia and Benchmark, the numbers became so big. It's like you don't have any room for early stage stuff. So I'll circle back to my earlier comment. It's a really good time to start a program. If you want to get into badass, like really good managers right now, you can do it. And that will probably be the case for the next few years.
When you say you can do it, where would you start? Because you have the big established brands, you have the up and comers, and you have the completely...
I would do both. I do what I do, which is a barbell approach. So you can get into some of the fanciest firms in the world.
Do you think you can? You can't get into Score unless you move a huge amount. You can't get into Founders Fund, especially with the kind of fund size reductions. I mean, Andreessen is, I'm sure you can in some of their vehicles. But like,
they're great. I love Andreessen, but
do you see what I mean? It's not that easy.
You need to be. Yeah, I hear you. I hear you in some. I mean, I think I also have like advantage relationships where I can get
But I'm saying for like random family office, multi-asset manager, whatever that is, if you're kind of knocking at the door of Founders Fund and Lauren, she's going to say,
yeah, you got to be kind of like what I was doing, which was like,
you got to be early.
The new Founders Fund, right? Or, someone who's edgy.
100%.
And I look back actually, and the mistakes I made in some ways is the buyout side where I backed some alphas that like were not great, but like backing Peter Thiel, it kind of like makes up for
everything else.
Some of the other mistakes. So like I'm not going to be too critical of myself doing that.
Can I ask you a tough one? How do you think about like how long to have unwavering support for? Often LPs are cited as having like 3 fund commitments.
Well, I'm often like one of the first people to go into a fund, like or back a first time fund or whatever, and one of the first people to get out.
What's the reason to get out?
It's usually it's the fund size is getting too big, or the team composition has changed, or the person, people are phasing out. Or you just kind of like, it's just force ranking.
Or do you not just accept, though, that given your incredible selection on emerging managers, which you have with Thrive, with Founders Fund, with Andreessen, the best generally...
Yeah, and the buyout, I do more in buyouts, actually.
But if you think the best generally scale, and it's like, I love Michael Kim, but, they scale out of his programs and he doesn't follow them, and I think he should. Honestly.
I think so, too.
But my point being, like, the best scale, and so... Do you churn because they scale? Because Yeah, Thrive are great, Andrews.
No, I'm more talking about buyouts. So, and this is you're a VC guy, right? But like my world is right now I'm spending like the vast majority of my time on lower middle market buyouts. And I'm so excited about like the opportunity set I'm seeing. And actually I'm going to generate like venture-like returns in small cap EBITDA positive businesses, right? So in my barbell approach, the way I do it is in venture is probably it's like 50-50, like franchise versus emerging. It might even be like 70% franchise, 30% emerging. Actually, I think, yeah, those are the numbers, right? And we actually, we realized that when like people like Josh Kushner or Neil Mehta, they went from being emerging to being franchise.
Yeah.
And that's why we backed you and, I Log Gill, Oren Zev, Ray Tonsing, there's like the OG, like older, but then the Lockie Grooms, the Josh Buckleys, the CEOs like Jack Altman, who introduced me to Zach Perret. We realized that if we just invested with Thrive, it was going to be more and more growth because those funds are 80%, 70, 80% more later stage. So we had to backfill that. And then there's advantages to that too, which is I think the absolute return, if you got to build a basket, right? But the basket, I think, can do 5x of those seed funds versus what do I think like a franchise firm can do? 2.5, 3x net, maybe 3.5. I mean, Andreessen has.
It's tough to do on $1 billion.
I think, you get a Coinbase of major holding that can move the needle on $1.5 billion fund. I mean, we saw that last week, but it's more rare, right?
If we just take this, and I'm just going for it, maybe say what's Coinbase's market cap today? It's 8-10 billion.
Yeah.
Okay, so 8-7 million, say, and they have 10%. Okay, we've got 800 million back to us, say, okay, and it's a 1.6 billion fund. Returns half the fund. Amazing. Need quite a few more to get to that 3x.
Yeah.
And that's a Coinbase. And we need an Airbnb in that fund as well. And then we might just get to 1.5x. And then the rest might wash our face and get to 2x.
Yeah, I mean, I'm just.
Do you know what I mean? No, I'm just like, I think it's so hard to do those great numbers on those size funds.
I don't disagree. I think, and that's why I think at the end of the day, I would put a more banded return, say 2.5 to 3.5 net. And maybe if it doesn't go well, you make, 1.7,
yeah,
2x, whatever. And that's the beauty of like what I do too. It's like it's hard to lose money.
It's what I love about Founders Fund.
Well, I'll say like Founders Fund, like there, if I'm saying some of the data, like there's a number of examples of big funds being 5x plus, right? And so it happens. But you have to be the best people, right? Circling back to the emerging. So yes, I think on an absolute basis, because Jack Altman's raised a $20 million fund, right? Or, like the numbers work well that you can do multiples of that if he catches one or two good ones. So I think the basket can do 5x. But you're seeding the next gen leaders, right? So you have optionality to go from writing a $10 million check to a $100 million check over, per fund over time. And then you get co-investment because they're early stage funds. So they're going to tap out. And often I might see, Founders Fund might be leading a deal from one of my seed managers that's tapped out. So I have like great insight into the company. And so that's been super powerful on that front. But circling back to the other thing we were saying around like, why do we get out? I mean, HarbourVest, for example. I love HarbourVest. There's a lot of people there. And they're on the primary team, you have a lot of people and they have their relationships and they like their people. And it's like when you have an organization with a ton of people get protective of their own relationships.
Sure.
The way we run it at SCS is it basically flows up through me. And so you can have a brutal intellectual honesty and you can say, okay, yes, that firm's great. But that leap from going from 450 million to 1.2 billion in the lower middle market side, you just completely changed your strategy. You can justify it, but like it's totally different. And yeah, I'm sure they're really fine. And they're good guys. But there's another fund that's 200 million, and that's, I think will deliver a higher return. And also then you have the optionality to what is the next fund and the next fund. Like, so that's where we're gonna, that force ranking, that intellectual honesty, and it requires, I think, a level of trust and transparency with managers. And there have been examples where I overshare and it backfires, but more than the vast majority of time, people really appreciate transparency.
You mentioned the direct investing there being such an important part. Why do you think it is such an important part? People often take binary approaches. We don't do it at all. They're massively active in it. You've done Andrew. I haven't been allowed to say, but you've done Andrew. You've done big, yeah. Rippling. You're in some of the best.
Yeah, we are.
What, yeah. I'm telling you as a neutral observer. So why is it such an important part of the program for you? And what have been lessons for you from doing the direct co-invest program?
Yeah, sure. Great question. Well, first of all, like from a fee perspective, and we have like over 100, it's maybe 130 or so direct investments. Essentially no management fee, like 10 basis points blended. And the carries like 7 or 8%, which is, there's a bunch of deals at 0, and then some at 10, and then it'll be tiered. And by the way, like I'm totally fine with paying carry on co-investments. But in general, it's a massive savings. But more importantly, I think you get to know the portfolio better, right? I mean, I know the co-investments I do, like I know those companies a lot better, but you get to see how managers underwrite deals, and you get to, get to know the people on the team too. You get to know the analysts. So it just deepens the relationship. But I think what's really important is to build, again, Harvey, you build a portfolio of co-investments, because by the way, like we've made a bunch of mistakes, What have you learned from the mistakes? Well, this is obvious. Like management is like super important. Having the right management team in place, like if you don't, that can be problematic. I would say diversification. Like we invested in this company called Smart Tours that did like different like tour operate, and like COVID smoked it. Okay.
Harsh.
It's fine. Yeah. Right.
How do you think about position sizing with that in mind?
If you think of like our vehicle, right, it's about 20-25% co-investments. So at the full, and we raise these vehicles every 18-24 months. But at the high level, it's like a co-investment it will max out around 2% exposure. But it's probably going to be typically, 50 to, 1%. And the co-investment sleeve, we want to build probably a portfolio of 20-25. But we'll have some like Andrew that we'll like lean into and make that, a 10% position in the co-invest sleeve, which then equates to, 2% in the overall vehicle. So definitely there's a big range. And I would say that having a range of investment size is one of the things that's like the best for me. So I'll write co-investment checks. My typical co-investment is somewhere between kind of 10 to 25. I'll go up to 50. I'll go down to 5. Funds, I will write checks between 20 to like 100 million. And actually in the seed venture, it's kind of like 5 to 15. You showed me an opportunity, like $1 million. I was like, okay, whatever. Like we just did like $1 million, but having that flexibility, because I don't even remember.
I remember calling you about 20 growth, 20 sales. And you're like, how much? Like $1 million.
Yeah. And I just, whatever. Because I view it as a relationship, and not to be like flippant with managers, but like at a certain point, I don't remember what we put into each fund. I just view it as like, it's a relationship with Greenoaks. It's a relationship with Harry. It's, and now I'm 12 years in, and it's like, I feel like we're just getting started. I mean, time flies.
Can I ask on the direct co-invest? I feel there's also a binary approach to the diligence processes attached. People are either we're going to do a huge amount of work and take 4 weeks, as you said, or we're just completely blindly following our managers, which isn't
I'm in the middle. I'm in the middle. Yeah, no, it's a great question. This is really important. You have to know you're an LP. You're not a GP, right? I mean, I think there are family offices that actually operate like GPs, but so we only do co-investments right now. I think we'll probably evolve over time, but we only do co-investments with our highest conviction managers in their areas of expertise, like deep areas of expertise where they're fully aligned. So when you put that filter on it, you know, I would say you should want, like, your hit rate should be really high, right? And so I'm not trying to re-underwrite. If a manager is putting 10% of their fund into a deal and they think it's one of their best ideas, I'm not there to like re-underwrite everything. First of all, the deal has to make sense for our returns. And that typically is at least 2.5x, like 2.5 to 3.5x base case net return with a right tail. And with a right tail where where I hope I can make 5x plus. And my goal is generally not to lose money. I've lost money, but you feel like you have 1x downside protection. That's kind of the parameters with the way we do co-investments. If you go at it that way, then what I'm going to do and what's going to make me good, where I have an advantage, is I have this huge network of GPs and stuff. For example, in the buyout world, like if there was an auction and they won the auction, I can probably talk to the firm that was number 2 and see what they think, or talk to another firm that's got like the competitor to the company. You have to be really careful, and I'm always very transparent with like GPs. Like there's situations where they're like, do not talk to anyone about this. And I'm like, okay. Because the worst thing I could do would be to blow up a deal. I've never done that. I know it's happened because I remember a GP wondering who blew up their deal. It was another LP that did it. But that's really important. But once you have the sign off or the implicit ability to tap into your network, I can get really interesting insight really quickly. The second best thing you can do besides say yes to co-investment is quick now. And so we move quickly, you know, on it, and try to get an answer to a GP within, you know, it's either like no within a day, or we're very interested, like, well, let's get back to you in like a day or two.
Yeah.
And we can execute a deal in a week or less. And often, 2 weeks is great if we have 2 weeks, but like that is like super important. And so we had to change our process actually with the investment committee, because we do standing investment committee every other Monday, right? But for co-investments, we don't need to convene investment committee. We send out a memo, and the investment committee has 48 hours to reply.
Wow. Because
that actually was like really important. Now things will slow down.
What percent are rejected?
Oh, very few get rejected. What percent by the investment committee?
Yeah.
Almost never. The investment committee, I can count on one hand the amount of funds or co-investments that have been declined in my 12 years. And I remember them well.
Is there a point in having it?
Yeah, I think so.
Which is oversight?
Yeah.
I'm just saying, if there's like 3 in 12 years and there is a 5% chance.
Well, it makes us do better work. Right.
So it's like an accountability mechanism.
Yeah, I think so. You're being a little cynical, but yeah.
No, I mean it in a nice way. Like it's good to hold that bar high. It's good from a governance standpoint as well.
Yeah, there was one circumstance where something was declined for exposure reasons, and it was right. But the other ones probably were not. But it's educational too for the rest, because senior members of the firm.
It's good to bring everyone else with you.
Yeah.
Yeah.
Your question about like our hit rate on co-investments is generally, it's like, I don't know, it's like 35% maybe. It might be a little lower right now because it's tight. But I say to my team, I'm like, why isn't it 50? Why isn't it 60? Like these are, if we have those parameters, yeah, we'll see. But it's super scale. It's important. It's scalable. I think if you'd asked me 2 years ago, what I was worried about was the flow and lower middle market buyouts on the co-invest side. And we've been very active there and love. So I'm feeling that was one of the only things I was kind of insecure about. Now I'm feeling really good about that.
How much cash do you need to do a direct co-investments program and to do it effectively?
Well, I feel really strongly about the need for scale. So we could pivot a little bit in this conversation. And like, when I joined SCS, we had $7 billion under management. I think that's around kind of the low end that you need. If you're gonna, when you back into what that equates to from a private equity allocation. But I think I was investing maybe 250 million a year. At that point in time, now it's like about $1.5 billion. There's a minimum scale. Like if you're investing $30 million a year, like that's not enough money. Unless you want to do something like really concentrated, but I don't believe I don't recommend that. So to have a co-investment program, it's like, well, what check size do you want to, like, it kind of all solves into like, how diversified do you want to be? How much is co-investments relative to your budget? But I think that you need to have a diversified portfolio. And I think you need to be allocating hundreds of millions of dollars a year.
Can I ask, do you think the incentives are aligned in terms of wealth managers today, in terms of private banks today, and how that plays out in the ecosystem?
Yeah, no. So this is it's amazing to me. So if we go back to the founding of SCS, our founder, CEO, Pete Mattoon, or now executive chairman, it's a force of nature. He was at this firm called Scudder, Stevens & Clark. He opened offices all over the world, like Latin America, I think, and at like the age of like 42 or 43 or 44, he made like 30 or 40 million bucks, something like that. He had a nice like wealth creation, and he was like trying to figure out like what he wanted to do with his money, and also like what he wanted to do like for his life, like his next act. And he's like, there is a gap in the market. There's all these like, investment banks that sound smart, but like they're totally conflicted and are pushing product. And then there's these like really aligned, small boutique, people that are really good at like trust and estate stuff and like, but they don't know much about investments. What if we do something in the middle? That was his thesis. And I think the thesis basically, it's one of those things like the pitch deck, like, it can be refined, but like it's still
solid.
It's still totally there. It's amazing to me that the wealth management industry, multifamily, that it continues to be, so fragmented, so underserved. But if you think of like, if you're at Goldman Sachs or Morgan Stanley or whatever, like the funds they put on their platform are large cap funds that are having trouble distributing. They need, like, we invest in Advent in the large cap buyout. We invest in Advent and CVC. They would never have their fund on their funds are like 2x oversubscribed before they start. They would never go onto an investment bank's distribution platform.
And you saw it with venture, by the way. I mean, I won't
oh
name
my
names,
God!
but some of the big players.
If you see a venture fund on a bank, holy shit! Like that is not a good sign. And I want to be careful.
But what worries me is and it makes me sad, is there's a generation of European family offices and institutions who did just follow that and then go, venture's shit, because they look back at those numbers now and they look back at those funds and go, pfft. And so it's like if they're smart, they'll realize that they were not going about it in the right way, and there are a lot of people right now are licking their wounds. Like a lot of people. Going back to the start of our conversation, about like, 06 and 07, like a lot of people poured a bunch of money into like large cap buyout stuff, and then, didn't commit after the goal for like 09, 10, 11, 12, and they missed some of the best vintages. Like obviously when like market's correct, that is when you want to be investing. So you have to have that mindset. Do you believe that LPs are pulling back today to the extent that people are saying? If you go on Twitter, everyone's like, the LP pullback's real. The LP pullback's real.
Look, and I'm just super transparent with people. I'm like, look, it's like we're very tight, but we make exceptions for exceptional managers. But it is causing a force ranking of things right now. And I think that some LPs are upside down, and there's going to be a really interesting opportunity, I think.
What are those opportunities? Like strip sales, like buyouts? How do you think about those?
No, on the secondary side, like so, it's been announced. Sequoia Heritage and Brookfield have created a company called Pine Grove that's going to be dealing with kind of like liquidity in the LP ecosystem. But also, if you thought you were going public this year and it's going to be like 3 or 5 years, like there's probably with employees, and it can be a win-win, right? You start if you're at a company. And it goes, let's just for round numbers, like it's worth $20 million, right? You had no idea, and you own whatever, now you have like $60 million of stock. When you joined, you didn't know it was going to go like that. And if you're selling at 30 million, if you sell 10 or 20% of your stake at half that to buy a house, you still own 80% of your shares, and your wife's happy, and whatever, like this can be a win-win. Like it doesn't need to be a negative. I mean, and I've seen that like scenario actually play out. The other thing that's interesting about the secondary market is that most of the secondary people are not really comfortable in venture.
What do you mean by that?
They like buyouts. Yeah, it's hard to underwrite. So
what does that mean for how they deploy or how they invest?
Well, I think all the big secondary players skew heavily towards buyout portfolios. So there's a gap in the market.
I think also the level of cynicism they bring towards things. Like I've spoken to someone like, we'll only engage at 80% discounts. And it's like, that's unreasonable for assets that are actually very premium assets.
There are a lot of the players out there who will do venture, and there's only a few. I think Lexington will as well, but they will not do it at scale. So what Pinegrove's going to try to do is, be a solution provider at 50 million plus. And it's not to say there's not like other people that will do it. Like I'm sure it is a great market opportunity. I'm really excited about that one. I think it's going to take time to play out, but when things were going nuts in 2021, it was like, I would see pitch books. Like I'm going to go back to like buyouts a little bit, but every mid-market, it was just like levered beta, right? Every mid-market fund was putting up 50, 60, 40, 50% IRRs. You couldn't tell, like people who had no skill, everything looked great. And of course in venture land, it was like just beyond silly. And I feel like we were doing very like nuanced, thoughtful work, but you couldn't tell the difference between that and not. And so in this new environment, I think that, the tide is going out. It's going to expose people. And, I think our relative returns will be, even if the absolute returns are not quite as high, the relative returns will be better. And I feel like we've taken a lot of our lumps. Like you talked about the venture marks earlier. Like I feel like we've written down our portfolio in the venture. When I say we, our managers, I don't know, it's like 25%, 30% after having years of 100% IRRs. So it's still good. It still looks good. I think it's a 29% net IRR after all that, and the buyout's like 25. So venture has paid off for us, but it would have been 2 years ago, that number probably would have been like in the 40s, right? And I don't think we've taken all our pain. I think there's more to come, but I think we've taken like 70, 80% of it.
Can I ask, from investing in some of the best over the last 12 years with SCS, are there any lessons or observations when it comes to liquidity management on how the best get out? I think a generation has been taught about lean in, and actually liquidity management and liquidity planning is crucial. Yeah. Are there any lessons from the generation of managers you've seen and backed? The best do get out.
Yeah. Well, I don't know if anyone did a good job at it, really. I mean, there are a few exceptions. I mean, that was my biggest mistake. There was a company that we invested in a $200 million valuation that had gotten bid up to $6 billion. And I had people like legitimately like trying to buy my shares. But I was told it was going to IPO at 10 to 12 billion in like 6 to 12 months. And the people I was in it with were not sellers. So they were long it. You fast forward, I mean, I would sell that at $1 billion valuation today. And I'm worried. I think it's a little binary right now. I think it could be worth $3 billion. It could be worth $0.
Would you do anything differently now, having had that experience?
Yeah. No, I will sell. I will. And now to tack and maybe pat myself on the back a little bit. By the way, that deal hurts more than some of the stupid deals I did on like frothy pricing, because of like, it wasn't like I like needed to seek out like a buyer, like they were coming to me. But the secondary thing is, it's obvious like when you want to be a seller and a buyer, like, and so we were able to execute a secondary sale of like a bunch of like tail end stuff with managers we weren't continuing to back at like 94 cents in the fall of 21. And it was bought by another multifamily office who's trying to build a secondary portfolio. They were like trying to like build a product. And like I was very happy to be a seller of that. I also sold a manager that we got out of because of some ethical situation at 104. Yeah, I mean, so I did execute a couple of, and I have relationships with Evercore as well as some boutiques, and we are now getting every 3 to 6 months kind of pricing, because the bankers will work for free. They're pricing the portfolio, and right now, I think if we wanted to sell some of our venture stuff, it'd be very unattractive. So we'd be a buyer. Right now I'm a buyer, not a seller, but I want to continually, that we were doing it, but I want to, like, that muscle is going to be built.
How do you think about liquidity planning and like forecasting when you think about kind of IPO markets being where they are, and when you think about when, you know, the moolah and the cooler, so to speak, comes back? Like, you are insatiable at finding the best talent, I think, and winning it and getting.
Well, I think that's where, if you like, the lessons learned where I think I can be better is actively managing liquidity. And there's a company, again, I don't want to name names, but it's a great company. We did a co-investment with our manager, and it's been marked up 4x, and it feels fully valued. I think the person's a complete assassin who runs the company, and so it could easily have a 2x plus from here. But like, am I a buyer or seller? Like, I'd be a seller, but like, you can't necessarily, like, I talked to this person, the GP, about, it's like, hey, could we think, like, how are you feeling about this? Like, should we try to sell? Because I think I would, like, there's a premium on getting liquidity right now.
Yeah.
And that's one where I'm like, it feels full. It has felt full every step of the way. But yeah, and so I don't know, I doubt we're going to get liquidity, but I'm proud of us for at least like asking the question and managing it. But to tack a little bit, I would say, as it relates to like the private equity market generally, I think second, you know, I worked at HarbourVest, I was in the secondary group, and I've seen that evolution, and I think it's awesome. Private equity in general is like, you just have unfair advantages over the public market. You're able to plan, you know, 3 to 7 year plans, not manage quarter to quarter. You can optimize your capital structure. You can innovate and venture, whatever. The reality is these funds, like, if not like cleaned up, will last like 12 to 20 years. Like it, and so the more kind of tools in the toolkit that institutionalize and give different off-ramps for liquidity, I think is amazing. And so people talk about all the capital that's been raised and this and that. And I'm like, yeah, it's still the penetration of private equity in, say, the US, UK is like, it's, what is it, like 5-10%? I mean, it could probably double. In markets like Germany, Germany is a third of the penetration of the US and UK and Nordics. Nordics might have the highest penetration of private equity.
Good old Nordics, always leading the way.
Yeah, they've done really well, right? But I say bring it on, and all this money that's been raised, people talk about like all the dry powder. And my strategy of investing in lower middle market guys, it's great because all these middle market guys need to buy companies. They raise the money to deploy it, and so there's a huge buyer universe that's out there. And you know, the other thing I was just say, and just actually to break down, because I know you're a venture guy. So you buy a founder-led business, you professionalize it, you buy it at like 6 to 8 times EBITDA. You put on like maybe 3 turns of debt, maybe 3 to 4, depends on the business. But you professionalize it, you grow it. Say it had 5 million EBITDA, you grow it to 25 million EBITDA. And then the next buyer, the mid-market buyer, will pay, you know, 10 to 14 times EBITDA for it. And they are going to lever it, you know, I mean, it changes, interest rate environment, but like 5 to 7 times. And that math works really well. So you're able to like, you're taking small business risk, and you got to know what you're doing, but you're not using that much leverage, and you're about growth and professionalization. Like it's a really repeatable, and there's a huge basket of buyers. It's like a really repeatable, great way to make, 3, 4, or 5 times your money.
I completely agree with you. And I love that. You're a venture guy, Harry. Yeah, no, I am. Whenever I talk to you, I'm always like, wow, the depths of your level of understanding of venture is quite astonishing given the breadth that you have.
Yeah.
I don't think people appreciate that enough, actually. Do you know what I mean, though?
Yeah, well, the venture stuff I get when it's a growth deal, I'm like, I can understand it, right? But this is the same for venture buyouts, energy, real estate. It's optimizing having the best partners, right? And being the best partner to the best partners.
Well, I think that's it exactly, there, because you can actually pick, but if you're not close enough to them, you're not going to get the alpha, especially on the direct side. And I think that's where, like, when I chat to Jack or I chat to Nico or Josh, I mean, I say this like but we just love working with you. It's a very unique relationship you build with managers, which I think is a real superpower. Which brings me to something that I do want to talk about, which is like different types of LPs, because I think a lot of managers aren't quite sure what's actually behind the wrapper. And so when we look at, say, endowments first, often blue chip, highly respected, what do you think managers should know about endowments as LPs that they maybe don't?
The endowment's probably like the team, right? You got to understand like what's going on. Like Notre Dame's endowment, like they all went to Notre Dame. They've been around a long time. Brian's awesome. Like that's a really solid one. Or, look at Harvard, have had team turnover in the past, but now they have like a new regime in there that's great. And they're actually doing a lot of new stuff. And you can't paint it with, the same brush. So just understanding the people and like how solid that foundation is. Because if on the flip side, like a new CIO comes in, there's a big team change, like that can very stable base of capital, but there can be team instability. So that's really, I think, the main thing on the endowment.
Do you think people overemphasize how stable endowment fund money is?
There is that herd mentality, right? And so, there's currently like a seed manager, and I'm like, you kind of want the different food groups. Like, you want to have your endowment, your single and multifamily office, which I'm biased, but I think it's the best. Maybe a fund of funds that can be like, they're really good people and be thoughtful. Because, for example, like I don't wake up every day thinking about like venture and stuff. And so if you have a venture specialist fund of funds, like there's things they're going to do that can be more thoughtful than more diversified pool. If you get money from endowment A, endowment B, endowment C, endowment D, that all like are very close to each other and talk to each other, and then one of them leaves, then they might all leave. So having diversity of like mindset, and you could probably, there's a crew of LPs that I do stuff with. But I think we think it generally independently. So maybe you need to be thoughtful and like, oh wow, they all do a lot of the same things together. Maybe like it would be a problem if.
What do you advise managers on concentration, just in terms of, percent of funds? Sometimes, some of the large pension funds we talked about earlier, yes, they do have the 10%. I know some though that will say, we're happy to be 75%, but we need to do 100 million. Like, is it the standard 20%?
75, that's a lot. Yeah.
It's a lot.
I'm like half a couple of funds. I think.
Is that okay?
Yeah, it is. But if you're asking me, you're raising a fund, I think you don't want to have too many LPs, but you also want to have diversity. So I think probably max out, ideally, at least at scale at, call it like 20% would be a lot.
Yeah.
That said, there's a number of managers where I'm more than that, but I think, we've built that trust. And but I think sizing probably your LPs between, 5 to 20%. And then having a tail of strategic small checks, I think is a good idea.
What do you think are the biggest mistakes emerging managers make when raising? You see so many. You've backed a generation.
Yeah. If you're really good, you can have your cake and eat it too. So you want to invest. You want to have your LPs. By the way, like these are long-term things, right? So it's like funds last longer than like the average marriage, like for sure, like right. So
totally.
So
right.
Think about it like that, right? And so
They're harder to get out
don't
of.
Don't just take the quick money, right? And you want to have, a very stable base of capital, arguably growing, because like we've grown, like you want to maybe not just stable, but growing base of capital, in a place that's not too bureaucratic, right? where you can get answers quickly. You don't have like a ton of red tape. In my opinion, is better. And then it's like, are these people I want to like partner with for the long term? Do I enjoy them? Are they good people? Are they, honesty, integrity, smart, like make me better, but also not be annoying? Because my whole thing is like I want you to do your job. I'm not going to bug you. I want to be there, and you ping me on the weekends and, whatever. I'm like, yeah, sure. But I want to be receptive when you need me, but then not put you through the ringer. Like, I want you to spend your time with entrepreneurs, not with LPs.
Why do you think the bar is low for competition in the LP world?
Well, I think it's structural because a lot of the big pools of capital have very bureaucratic structures and low pay. So that's the big one. Fund of funds are transactional. They're trying to raise their next funds. They're often like trying to like cut a deal, like get like they want to look good early. And I'm like, I'm thinking about this, like I only have so many bullets. I'm thinking like 20 years, multiple funds. Doing an attractive deal with a B+, like B+ A- manager versus playing the long game with an A, like just play the long game, right? And that will come. I don't know. Did I answer the question?
Yeah,
I think, and we've seen this, like our wealthiest family, the family that brought the reason I was hired at SES, because they had the mandate that was like 250 million. I built the whole thing across our base of families. It was 90 families and 7 billion. Now it's 200 families and 30 billion. At one point, like the guy got cancer, and that, like their allocation like went to zero for a period of time, and he died actually. And then there was a bit of a upheaval around. So you have single family offices, like things happen. We've had another family where, it's tragic. But the woman we work for, her husband, she was an heiress, and her husband, like she's in her 30s. He was like early 40s, maybe. He died like suddenly of a heart attack. They had, like, a couple of young kids. Like their allocation like slowed down to close to zero for a few years, right? And that's, by the way, like, totally understand that. But that's why I'm obviously biased, talking my own book.
Well, that's why multifamily office is great. I think
multifamily, and the other thing I'll say, is I'm giving you some real examples of like really big family, and like, whereas if I were just working for a single family office, then, and that happens, it changes things.
100%. And like for you with that in those situations, yes, it might mean that your budget's a little bit less for that given year, but actually you can still commit to the managers in the way that you want to. You can still be there and actually...
we might commit 35, not 50.
Not a problem in a real way there. But actually if you are the CIO of that family office, or they are your sole LP or whatever that is,
then you're on pause. And by the way, are you going to tell that like they have a legitimate reason to be on pause?
Totally.
And so that's the risk on the single family office side, where I think and the other thing I'll just say is like, it's funny, people make some money and they think they want to like start a single family office. Like, why? I think that like,
why? You have to manage them.
You have to have a reason.
Geez, I never get that.
You have to have a reason. Like, I think it's definitely not $1 billion. Like, I think you have to be maybe worth 10 billion. At least 5.
Why? Well, sorry, that's fascinating. Why? Because I see people start them with 50 million, with 100 million.
It makes no sense.
Why? There's a lot of people who listen who have 50 to 100 million who either have one or are thinking of one. Why?
The benefits of a multifamily office, you get like, you pay a lot, like you get the scale of a big organization and all their institutional learnings and like lower fees and access to investments. If you're subscale, it's probably you're gonna have a less sophisticated investment portfolio, and you're gonna pay a lot more. Unless you're doing direct deals, like you know what you're doing, like you wanna, and you can do that. We work with a private equity guy who's like brilliant, who has like, he works with us, and then he has like a team of people but like you have to have a reason to do it.
Oh, I think one of the biggest mistakes that family offices make is that they think they can play venture and play direct with, Peter, who does venture for 2 days a week.
If you have 50 million, so let's just like back into it. Like, or let's use 100 for round numbers. Okay. What should be your allocation to privates? Like, let's just say, I'm like over 50%, but our typical family is like 35, but let's just say 50. Like, I'm probably like 70, but I eat my own cooking. Okay. So you want to be 50% private equity. Okay. That's $50 million. You know, you shouldn't allocate that all in 1 year. You should do that. You should build that portfolio over time.
100%.
The rule of thumb would be, the way it works is essentially you'd want to commit a third per year. So that's $15 million a year.
I'm almost surprised it's that much per year given liquidity windows. If you think it's going to take 10 plus to get that back, and maybe 7.
It's like over 6.
Do you see what I mean? Though?
I agree. I'm giving you kind of like.
I'm saying I'd do like 10 million a year over 5 years.
Yeah, you could do that, but if you really, you're not going to get ramped. You're going to end up at 30. If you have to overcommit. I mean, you have to in order to get your NAV at 50, you have to have outstanding probably 20 million in commitments at all time. But in this scenario, okay, just if you follow my swag model, that's 15 million a year into privates. Same privates, like generally. Let's just say you don't do real estate or natural resources. You just do private equity. Okay, what's the mix between buyouts and venture? That's the way I do
10 and 5.
The way I do it is, I just even 50-50 or I don't know, whatever. But that's okay. That's $7.5 million. Annually. And how do you want to like invest? So how many funds are you going to back? Like, you're going to write and people are going to take you seriously? Like, unless you have personal relationships.
I think you can see people do $1 million checks. And you're going to go into emerging managers raising 15 to 50.
Yeah, and there's so many shitty venture funds out there.
Oh my God.
I see it. I can't. And I'm just breaking it down. And what should you do? You should probably, in that scenario, you should either partner with a multifamily office like SES, or you should invest in a fund of funds. You should not be doing 7, because wait, how did you just find those 7? Like, you don't have that much money. I know you made $100 million. You feel really rich, but I'm just like,
no, I get you, but the best manager is not going to meet you for $1 million if you're not
unless you're like friends with them.
No, I totally agree with you. When you walk it back like that, it's like, ooh, it gets very real very quickly. Is there anything else that you think that managers don't know about the LP world? Where you think that emerging managers make mistakes on when they come to you?
I think it's just, I think one thing, I'm a big proponent of doing targeted, like not meeting like 120 LPs and taking their first dollars, but like having like a thoughtful, like do 20 meetings and try to have a, 40-50% yield.
And also like,
but so have appropriate diversification, but like, it means a lot more to get referrals through trusted sources. Like, I don't do cold emails, and like, I knew who you were, but like having it was Nico,
and then we had Josh as well, who knew each other, and then I
but there was you're a different animal. But like if you reach out to me cold right now, like maybe when I started at SCS I would respond, but I can't. You have to show some sort of like figure out a way to hit me up. But then like I advise managers, think about hiring a boutique. This is more on the bad side, but they have 2 options. They can go with like a boutique fundraiser placement agent, or like one of the big guys. And I always generally say go with the boutique because they're much more thoughtful about it. Doing like 100 meetings with like it's just
It's so funny you say about fundraising agents there for
in venture. You shouldn't use one at all. It should be all network.
Good, I agree with you there. I see them sometimes.
If you see a placement agent in venture,
on the fund side or on the direct like company investing side, because we see it in Europe on like especially France, it's still placement agents for like companies, like seed companies. I'm not saying I would completely rule out a venture fund that had an agent, but it's a terrible sign. I would do. Yeah. Maybe I'm harsher than you are.
Yeah, never say never. I'm just like, yeah, but I'm, yeah.
Peter, is there anything you know now before we do a quick fire? Is there anything you know now that you wish you'd known when you started at SDS 12 years ago?
You know, I don't know. I mean, I think have my cake and eat it too in terms of like good people. Like I think I was attracted and still am to like the force of nature people, but like sometimes those organizations, if you have a certain personality, there can be more turnover. They don't have the checks and balances. So like really trying to like optimize with like not just the smartest people, but like good long-term partners.
Yeah. No.
You know, that's probably the only, and then like I said earlier, the like just making sure you're trying to find the contrary views. Like echo chamber's great, like, but let's take it as a given and then try to see what others are saying. Because that's why, if you think of what I scale, it's like I will maybe do 5, 10, 15 reference calls where these fund of funds will do like 60.
Yeah.
But one of my reference calls will be to the fund of funds that did 60 calls. Right? So like ways to work smart, you know, that's been an all unlock, I think.
No, I totally agree and get you there. Listen, I want to do a quick fire, Peter. So I say a short statement, you give me your immediate thoughts. Does that sound okay?
It sounds great. Let's
okay.
do it.
Let's do, what do others not know that you know to be true?
I think it's the diversification piece in private equity, the way to build an optimal portfolio, which I think is, I have 60, 70 active relationships in private equity. I think there's a lot of people out there that say it should be like 20 to 30.
How do you manage them at scale, Peter? You're also a real partner and friend to us. Man, how do you do that?
I work hard. Yeah, I have good teammates. I have a really, you know, Kyle, who you know.
Yeah.
You got, but it's a lot. There's a balance between, because I have, you know, I have an 11-year-old daughter, 6-year-old son, trying to balance family and work and all the travel. But I don't go to that many. I don't go to every annual meeting. You know, it's like you have to pick your spots, and I wish I could do more than I do, but like there's the balance between that, and then if you have too many cooks in the kitchen, you can't, you know. So I'm working on, like, the time piece is like the thing I'm constantly working on.
Tell me, you can call yourself up the night before your wife has her first child and your first child. What do you advise yourself?
I think like you figure it out. Like I don't have a good answer to that. Kids are the best. What I would just say, my advice to you would be like, definitely have kids. They're definitely the most important thing. And I love, like, my managers are like, my relationships are like my children too, but like, it's all the cliches. But also, like, you just kind of like react, and you kind of, you know, deal with each situation as it, there's no big grand advice I would have. Like, I have my wife was a lawyer, and now she's a full-time mom. She's like the best mom. Like, so pick the right spouse. That would be obvious. I'm very lucky, and I'm very involved on the weekends with my kids, but like, it's definitely divide and conquer, and like knowing that my wife is like on top of everything, so I can focus on Harry and work and all that, is huge. What's
the most controversial view you have on ventures today? I think the placing track records is fourth or fifth.
Yeah. I mean, I think that's, it's really go where the puck is going, right? And although that's probably more true in buyouts, I think, where the track record piece, because in venture there is brand, right? And there is, I think, more persistence of returns around brand.
Can I ask a tough one that's not on the sheet? What firm are you not in that you would love to be in?
Yeah, it's a good question. Probably Benchmark.
Same for me.
Yeah. So we're kind of in Sequoia, but like, and Kevin Kelly is like I love Sequoia Heritage. Yeah, I bet definitely like Benchmark. Rivet's done a really nice job too. And I think if I hadn't been as capital constrained, I've met with Mickey many times over the years. That's another great one.
You can have dinner with anyone, dead or alive. Who would you have dinner with, and why them?
I'm going to give you two, and both Brits, and I'm an Anglophile. But Winston Churchill would be the dead. I mean, the guy, his life is so amazing.
His approach and unwavering resilience.
Oh my God. Yeah, he just like,
the fortitude to stand by your beliefs in the face of everything.
Yeah, and his ups and downs. I mean, he kind of had the different acts in me, but he believed like strongly he was destined for greatness. And like, he like, when he was in his early 20s, like ran into battle. He was like, wasn't worried about dying. Cause he's like, how could I die? I'm going to do like amazing things. Like just a total character who was very irreverent and like my type of guy. So that would be I think, yeah, it's an easy answer actually for me.
Who is the second?
So the second's actually one alive, and actually one who I might get dinner with. So it's Chris Blackwell, who's the founder of Island Records, Jamaican / British guy who had a fascinating life. Really, he helped shape reggae music, but also back people like Steve Winwood, U2, and now he's a hotelier in Jamaica. He's got a hotel. He bought Ian Fleming's house, Goldeneye, and turned it into a resort. And my good friend Brian Sheth, who runs a firm called Haveli, is like good friends with Chris. So Chris is 86. So we'll see. Maybe it gets cold in Boston, and maybe a trip to Jamaica this winter. I've been talking about it for about a year now.
That would be some fantastic Instagram
maybe
stories.
you can come too.
I would totally come to Jamaica for this one. Go to Goldeneye.
I'll put the plug in for the biography. The Islander is amazing. It's just a fascinating life.
Peter, final one. Where's Peter in 2033? What are 10 years out like?
Well, in 10 years, my son Reed will be 16. So I'm living outside of Boston, doing what I do, I think. I think the more interesting question is like, where did that go when Reed goes to college? One thing I love about the LP life, being an LP, not being at that 10,000 feet or 30,000 feet, not like in the trenches on the deals, because I don't take board seats or anything like that, is like, I think this is something that I can do like into my 70s. Like I think I can maybe not be quite as engaged on the front end as I am today, but like I think I can continue to do this for a long time and do so in a way that, lifestyle wise, I can take more time and, enjoy travel, which I love and all, but I get so much positive energy from what I do and partnering with people like you that like, I don't see myself ever stopping this, or at least not for the next, I'm 42, so probably the next 40 years.
Listen, Peter, I've absolutely loved doing this. I want to thank you also. Your partnership means so much to me. Your friendship means so much to me. This has been a joy to do, and so thank you.
Thank you, Harry.